All right, everyone, welcome back to Ticker Shock, your go-to for navigating the wild world of stock market news. Today, we're diving deep into a company that's been absolutely dominating headlines, NVIDIA. The question on everyone's mind is, after their latest earnings report, is the AI giant still a buy, or are we seeing the first cracks in the foundation? Let's get right to it. NVIDIA just dropped their Q2 fiscal year 2026 earnings. And while the numbers generally blew past expectations, the stock saw a bit of a wobble in after-hours trading. We've got a lot to unpack here, so let's get straight into the news. NVIDIA reported a stellar Q2 FY2026, with revenue hitting a massive $46.7 billion, a 56% jump year-over-year and beating Wall Street's expectations. Non-GAAP diluted EPS also came in strong at $1.05, exceeding forecasts. The company's data center segment, which is their absolute powerhouse, brought in $41.1 billion, up a solid 56% year-over-year. They also provided a Q3 guidance of $54 billion, which again trounced analyst expectations. However, despite these impressive numbers, the stock dipped around 2–3% in after-hours trading. Why the dip? The main culprits appear to be concerns about a slight sequential slowdown in the data center segment and, importantly, the ongoing impact of U.S. export controls on their sales to China, specifically the H20 processor. They've excluded any H20 sales to China from their Q3 guidance, even though there's a possibility of getting licenses. So, while the overall picture is incredibly rosy, these geopolitical and market-specific headwinds are definitely on investors' radar. Now, before we get into the nitty-gritty of the numbers, let's quickly recap who NVIDIA is. NVIDIA, headquartered in Santa Clara, California, is a global leader in graphics and compute and networking solutions. They are the architects behind the GPUs that power everything from high-end gaming to, crucially, the AI revolution. Their business is broadly split into two main segments: graphics and compute and networking. The graphics segment covers their famous GeForce GPUs for gaming, but also solutions for enterprise workstations. The compute and networking segment, however, is where the real magic is happening right now. This includes their data center platforms for AI and high-performance computing, Mellanox networking solutions, and automotive AI platforms. Financially, NVIDIA is a behemoth. For fiscal year 2025, they raked in an incredible $130.5 billion in revenue, an astounding 114% increase year-over-year. Their data center segment is the undisputed king, accounting for a massive $115.19 billion, or a staggering 88.27% of their total revenue. That segment alone saw a 142% year-over-year surge. Gaming, while still significant, generated $11.35 billion, about 8.7% of the total. Other segments like automotive and professional visualization are also showing strong growth, but the data center is the engine. Geographically, the U.S. is their biggest market at $61.26 billion, followed by Singapore at $23.68 billion and Taiwan at $20.57 billion. China, while a significant market, generated $17.1 billion in the last fiscal year, but this is where the current headwinds are focused. Their gross margins are incredibly healthy, around 70%, and their operating margins are a massive 58%. It's a company firing on all cylinders, especially in the booming AI space. All right, let's talk numbers and how this news impacts NVIDIA's bottom line. The key takeaway is the impact of U.S. export controls on their H20 data center chips sold to China. This is hitting their largest segment, data center, which, as we know, is almost 88% of their business. So, how do we get to that number? First, the news affects their biggest segment, data center, and specifically sales to China. Last fiscal year, China revenue was $17.11 billion. If we approximate that as $4.28 billion per quarter, and the guidance explicitly excludes H20 sales, we can estimate a significant revenue reduction for that specific market. For our most likely scenario, we're conservatively estimating a 75% revenue impact on the China-specific portion of the data center segment for the next quarter. That translates to a revenue loss of roughly $3.21 billion for the quarter. Now, here's the key part: operating leverage. NVIDIA has robust margins, around 70% gross and 58% operating. Given their scale and ongoing investments, we're using an operating leverage multiplier of 2.0. This means for every dollar of revenue lost, their operating income could drop by $2. So, that revenue hit of roughly $3.21 billion when applied to their Q2 revenue of $46.7 billion represents about a 6.87% revenue decrease for the quarter. Multiplied by our operating leverage factor of 2.0, that's a potential 13.74% hit to their earnings. Now, let's translate that to EPS. NVIDIA reported $1.05 in EPS for Q2. A 13.74% drop on that means an estimated EPS impact of about minus 14 cents. This brings their potential EPS down to around $91 for the next quarter. We've outlined three scenarios: a no-impact scenario with a 20% probability, a moderate impact of minus 14 cents with a 60% probability, our most likely case, and a high impact of minus 30 cents with a 20% probability. Now, looking at the chart, NVDA is currently consolidating above its key support level in the 170s. If that support breaks, we could see a move down to the 150 range, with major support sitting at 140. On the upside, we're watching resistance at 192 and a significant hurdle to clear at the 200 mark. The market's reaction, a slight dip in after hours, suggests it's cautious. They blew past expectations, but the China situation and the slight sequential slowdown in data center revenue are definitely causing some hesitation. Given the strong guidance, the dip might be an overreaction. So, what's the final verdict? This news is neutral. Yes, the China export controls are a real headwind, and the slight sequential slowdown in data center is a data point to watch. But NVIDIA's overall Q2 performance crushed expectations, and their Q3 guidance is incredibly strong. The market's reaction, a modest dip, seems to be weighing the good against the geopolitical challenges. The fact that they can maintain this level of growth despite these hurdles speaks volumes about their market position. My personal take? For now, I'm calling this a hold. NVIDIA remains a dominant force in AI, and the underlying demand for their products is undeniable. The Q3 guidance is extremely positive, and the company is actively returning capital to shareholders with a new $60 billion repurchase authorization. While the China situation adds a layer of uncertainty, the core business is incredibly robust. I'm watching that 170 support level closely, but I'm not ready to exit this position based on this report. That's all the time we have for today on Ticker Shock. If you found this breakdown helpful, do us a favor and smash that like button, subscribe, and hit that notification bell so you don't miss our next deep dive. Remember, this is for educational purposes only and not financial advice. Invest wisely, and we'll see you next time.